You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the Deep Dive. Today, we're digging into just one source, but it's a heavy one, a global market and geopolitical brief from October 23rd, 2025. Covers a lot of ground, FX, commodities, trade disputes, the works.
Yeah, and our job really is to cut through the noise for you. We're not just reading it, we're pulling out what you really need to know, focusing on how geopolitics is, directly steering markets. What are those key things you need to be watching right now?
So the overall takeaway, the sort of vibe from this briefing, it's definitely caution. We're seeing a generally stronger U.S. dollar, oil prices getting a boost from sanctions and actual supply issues, and then this big cloud of uncertainty hanging over U.S.-China tech relations. Okay, let's unpack that, starting with currencies. They're like the market's pulse, right? Quickest way to read risk appetite.
Yeah.
Right now, it's flashing play it safe.
Mm-hmm.
The dollar is stronger, and the brief is pretty clear. It's because of, nerves about the U.S. and China butting heads again.
That's the classic safe haven move. When traders get anxious about the big picture, especially U.S.-China, they tend to run towards the dollar. And you see the flip side in Europe.
Right, like the euro.
The euro's definitely looking defensive. It's slipped under that 1.16 handle. That's, an important psychological mark. Breaking it suggests less confidence in the near term for Europe.
And sterling.
Sterling's softer, too. The briefing connects that back to a UK inflation number that came in cooler than expected yesterday. Takes a bit of pressure off the Bank of England.
Okay, so Europe's got its own issues, plus the global risk-off mood. But Asia FX, that seems like where the really interesting policy differences are playing out.
Oh, absolutely. It's a really stark contrast in strategies. You've got dollar-yen pushing higher, back above 152.
Why is that?
Well, the market's reading Japan's talk about fiscal reforms as basically locking in that interest rate gap between the U.S. and Japan. The Fed's higher rates keep the dollar strong against the yen.
Got it. And then you've got Korea doing almost the opposite.
Exactly. The Bank of Korea held rates at 2.5%. But, and this is key, they made a point of saying the door is still open for rate cuts maybe later this year.
Okay.
So you have Japan reinforcing the rate difference and South Korea hinting at easing. That divergence, that difference in policy paths, keeps Asia FX traders on their toes. Lots of volatility there.
And amidst all that swirling uncertainty, you have China's central bank, the PDOC, stepping in to manage the yuan.
Yeah, the usual playbook. They're leaning against the yuan weakening too much. Despite all the tricky headlines, they set the daily fix stronger than the market expected at 7.0918.
So sending a signal.
A signal of managed stability. They're saying, look, even with trade tensions rising, we're going to keep the currency relatively stable, prevent a disorderly drop. They don't want a falling currency adding fuel to the trade fire.
Okay, so currencies show the financial risk mood. Let's pivot to where risk hits the physical world, commodities. Specifically crude oil. It's better bid, prices are up. The brief says renewed supply route uncertainty. What's actually happening to push prices up takes real events usually.
Right. It's not just sentiment. Two main things seem to be underpinning oil right now. First, there were these reports about Ukraine maybe using Western long-range missiles.
Yeah.
Washington denied it. But the report itself adds a layer of uncertainty about escalation.
Okay, conflict risk.
Conflict risk, exactly. But the second and probably more direct driver is a new package of U.S. sanctions. This one hits Russia's energy sector hard, specifically naming giants like Rosneft and Lukoil, plus their subsidiaries.
Oh, those are big names.
Huge names. And these sanctions, they're designed to have teeth, impacting how people trade Russian oil globally.
Can we zero in on that? Because the briefing mentioned something really specific, a real-world effect on Russian oil going to India.
Yes, this is fascinating. This is where you see policy become reality. The brief says Russian oil flows to India's state-owned refineries are apparently set to fall sharply, maybe even towards zero.
Towards zero. Why? Is India suddenly siding with the sanctions?
not necessarily about siding with them. It's more about self-preservation for their refiners and banks. They're reportedly tightening up their checks on the shipping documents, the bills of lading.
What's a bill of lading,
And
basically?
think of it like the oil's passport. It says where it came from, who owns it, where it's going. India's refiners are apparently scrutinizing these documents really carefully to make sure the cargo isn't linked to any of those newly sanctioned entities, like a Lukoil subsidiary.
So they don't want to get caught handling sanctioned oil.
Exactly. The risk of getting cut off from the U.S. financial system is just too high. So they avoid the cargo. And that forces Russia to find other buyers, other routes, probably at a discount or with higher shipping costs. It's a direct hit from the enforcement.
That makes sense why crude is bid then. That's a real disruption. But other commodities aren't getting the same lift.
No, quite the opposite. Gold, for example, had some volatility, but it's cooled off, trading in a range now. And copper. Copper's really struggling.
Which tells us about industrial demand.
Precisely. Copper is often seen as Dr. Copper, a gauge of global economic health. It's lacking conviction because the overall risk mood is cautious and people are worried about demand. So the market's smart here, distinguishing between supply risk hitting oil and demand, worries hitting copper.
Okay, let's switch gears to what feels like the main event driving a lot of this caution. Trade policy, specifically U.S.-China tech controls. This seems to be where the biggest potential disruption lies.
Absolutely. This is the big one everyone's watching. The briefing highlights something potentially huge being considered by the U.S. administration. A plan, it says, to restrict exports to China from anywhere in the world.
Okay.
If those goods are made using U.S. software.
Whoa. Wait. Made with U.S. software? That's massive. That goes way beyond restricting U.S.-made chips or hardware.
It's a potential game changer. Current rules focus more on U.S. components or direct sales by U.S. firms. This new idea targets the intellectual property, the design tools. It means a product made in, say, Germany or Vietnam could fall under U.S. restrictions if American software was involved in its creation.
That throws a wrench into basically every global tech supply chain.
Every single one. And the source notes this is being framed as a response, a sort of tit for tat to China restricting rare earth exports earlier.
Right, the strategic minerals.
Exactly. But what's also really interesting is the tactic. According to the briefing, officials are floating this idea, publicly putting it out there, maybe to ramp up pressure, but without actually implementing it immediately.
So using the threat as leverage.
Seems like it. It's a pressure tactic, while they also trust they need to coordinate with the G7 allies before doing anything concrete. Strategic uncertainty is a tool.
So you've got this potential tech crackdown hanging over everything, but at the same time, there's still diplomacy happening. It sounds quite complex.
Very complex. Look at President Trump. He's got a long meeting scheduled with President Xi in South Korea. The briefing says he's suggesting deals are possible, maybe on soybeans, maybe broader trade stuff.
But isn't he also still talking tough on tariffs?
In the same breath, he's reiterating tariffs are important, even mentioning taking tariff fights to the Supreme Court. So it's this dual message. Let's talk deals, but the pressure stays on.
And it's not just Trump and Xi.
No, the diplomacy is wider. Treasury Secretary Bessent is meeting Chinese officials in Malaysia, apparently talking about next steps with allies if those talks don't yield results. Plus, Taipei's envoy to the U.S. is saying a U.S.-Taiwan trade deal is getting closer. It's happening on multiple fronts, sometimes seemingly contradictory ones.
So the big picture on trade is intense pressure, potential escalation, but also lots of talking behind the scenes.
That's the dynamic. Threaten with one hand, negotiate with the other, all across the Asia-Pacific.
Okay, let's zoom out one last time to the broader geopolitical landscape beyond just trade talks. Russia-Ukraine is still very active in these sources.
Very much so. We mentioned those big new oil sanctions on Rosneft and Lukoil. Treasury is apparently calling these some of the biggest yet and really pushing G7 partners to get on board to maximize the squeeze on Moscow's finances.
And diplomatically, President Trump canceled that potential meeting with President Putin.
Yeah, he canceled it. The quote was something like, "It didn't feel right at the moment." But crucially, he left the door open. Said he might meet later if it helps peace efforts.
Classic Trump. Keep them guessing.
It's that strategic ambiguity again. Signal displeasure, hold back the meeting as leverage, but don't close the door completely.
And the instability isn't just in Europe. The briefing touches on the Middle East.
Briefly, yes. Secretary of State Rubio issued a warning about moves in Israel's Knesset, their parliament, towards annexing parts of the West Bank. Rubio warned that risks undermining the fragile Gaza peace framework. It just highlights how sensitive things are there.
Okay. And one more flashpoint. North Korea.
Yep. Pyongyang claimed another successful test, this time a hypersonic missile. It landed outside Japan's exclusive economic zone, so not a direct hit, but still. Enough to keep Japan and South Korea on high alert. Tensions remain high there. Okay, so let's try to pull this all together for you. If you synthesize the briefing's main points for today. 1, the dollar's stronger, mostly because of that global caution linked to U.S.-China tensions. 2, oil prices are definitely getting support from real-world sanction impacts like those Indian refiners tightening checks. That's enforcement, you can see.
Yeah, that India example really stands out.
It does. And 3, industrial metals like copper. They're struggling. Trade uncertainty is just weighing too heavily on the demand outlook.
What strikes me is just how fast geopolitics translates into market moves now. The sanctions are announced, and almost immediately you see reports of specific trade flows like the India one drying up. It's tangible. So looking ahead, what are the absolute key things to keep tracking based on this? I'd say it's threefold. First, does crude oil hold these gains? Watch how those sanction ripples continue to spread. Second, the dollar's overall direction. Does risk appetite make a comeback, or do these geopolitical worries keep the dollar bid? And third, probably the most critical, any more news, any concrete steps, or even just more talk about those potential U.S. restrictions on tech made with U.S. software?
Yeah, that software rule is the potential bombshell. Which leads to the final thought we want to leave you with today. Think about all these pressure tactics we've discussed, floating the tech controls without implementing them, Trump canceling the Putin meeting but leaving the door ajar. How effective do you think this strategic uncertainty actually is? Is it better at shaping market expectations and achieving policy goals than just taking clear, decisive action, even if that action carries immediate risks? That use of ambiguity itself, it really feels like a central tool in today's geopolitics. Something to mull over.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.